Principles of Macroeconomics, Chapter 17, Government Budgets and Fiscal Policy, Professor Wagner. This chapter is going to outline topics such as government spending, taxation, deficits and national debt, the use of fiscal policy to fight recession, unemployment, and inflation, automatic stabilizers, practical problems with discretionary fiscal policy, also the question of a balanced budget. The 2013 shutdown of national parks is was basically something that occurred when the House and Senate had not come together on the resolution of the national budget. So the government ran out of money and they had to shut down various public entities. National parks were one of them. Government spending, so you have a budget deficit, and that's where government spends more than it has in a year, receives in taxes a year. Surplus is the opposite, where it has more taxes than what they spent. That doesn't happen very often these days. Balanced budget is when everything's pretty much in equilibrium. The spending and taxes are equal. Major spending categories: national defense, Social Security, health programs, and interest payments. And this is a graph depicting federal spending from the time frame 1960 to 2014. And what you'll see is total federal spending is as a percentage of GDP. It's remained kind of more or less level, kind of warbly, especially toward the end. But since 1960, the federal spending has ranged from about 18 to 22% of the GDP, but it climbed in 2009. It has a lot to do with government intervention in the 2008 Great Recession. Came back down to level at 2013. The share the government has spent on national defense has generally declined, while it spends a lot more on Social Security and Medicare and healthcare expenses. One of the major reasons for that is people are living longer. So Social Security, you were supposed to collect it somewhere around 65. Now it's 67. However, people are living into their 80s. So there has to be more in reserve to take care of that. Also, healthcare is something, namely Medicare and Medicaid, same type of deal. The expenses have kind of gone up gradually over the years as a percentage of GDP. Deficit versus debt. The deficit is not the debt. Government deficit or surplus refers to what happens with the federal government each year. Government debt is accumulated over time and is the sum of all the deficits and surpluses. This is a chart of federal spending in a pie chart, 2014. And so 6.5% of our budget is on net interest, which is basically what we pay back on treasury bonds of various sorts, the 2, 5, 10, 30-year bonds. All other spending is about 26%. National defense is about 17%. Social Security is 24%. Healthcare is about 26%. And so the four major areas, 73%, is spent on the four major areas. State and local spending, also during a similar period. Total spending in terms of percentage of GDP, state and local spending, it's kind of steadily gone upward from about 10%. Now it's somewhere in the mid-teens. Education spending has been somewhat level throughout this entire period too. It's about 10% of the GDP and about 14, in the early 60s to about in the mid-teens by the 70s. It's been remained at that level pretty much more or less since. The single biggest spending item is education, and that's about 4 to 5% of GDP in recent decades. Over, once again, the same period of time, the tax revenues have been about 17 to 20% of GDP. Primary source of federal taxes are income, individual income, and the payroll taxes on the finance, Social Security, and Medicare. Corporate taxes and social insurance taxes provide smaller shares of revenue. Taxes collected by the federal government. These are things you're all familiar with probably. Individual income tax, your 1040. Payroll tax, which is your Social Security and Medicare, it's taken out. Also, progressive tax, greater share of income from those who have higher incomes as opposed to those with lower, and what the U.S. income tax is. It's a marginal tax rate, and it can go anywhere from 10 to 35%. This has changed and evolved over the decades. So in that same time period from 1960 till present, there was a period of time where we actually had a 95% tax bracket for the highest bracket, and that was heavily tilted against those who were very rich. However, the legal system and how business and financial entities get created in the United States also became a rather creative art form of its own sort. So the super wealthy began to create or find tax dodges of one sort or another, because after all, who wants to pay 95% of whatever it is you earn to the government? It's kind of like counterproductive and a little bit punitive, I think. If a person, in this particular instance, that earns 35%, 35,000, their tax rate is 15%. You have these income tax bands here, and so it's not 15% on the whole paycheck, but the bands of income. The first 9,075 would be taxed at 10%, whereas anything in between these two numbers here will be taxed at 15%. Anything after that would be taxed at 25%. Here we have a list of tax definitions, types of taxes, and tax concepts. Proportional tax is just a flat percentage of income earned regardless of the income. A regressive tax is where people with higher incomes pay a smaller share of their income in tax. Corporate income tax is corporate profits. Excise tax is like gas tax, tobacco tax, and alcohol tax. It's basically a tax on the good itself. They're also known as sin taxes. Estate and gift tax, that weighs tax on people who pass assets on to the next generation either after death or during the life in the form of gifts. This one, I mean, a lot of people have different outlooks on that, but the people that get harmed the most by this are those people who have generational businesses or generational farms in particular, just simply because of the value of things. I don't know. Like I said, not a big fan of the estate and gift tax, but it's there. It's $5 million presently. State and local taxes, these are things like property taxes, sales tax of the 8.25% that you pay on your goods here in Texas. That's the state tax, and it's on sales. Property taxes are basically collected by respective counties, and that will be probably about 3/4 for the independent school districts that the county is responsible for. Also, revenue passed along from the federal government, personal and corporate income taxes. Texas has no personal income tax, and a relatively small corporate income tax. And then, of course, there's fees and charges. Some extreme examples are like New York City, where you have to pay a federal, state, and a city tax on income. Virginia is another really good example. I lived in Prince George's County, and they actually had a tax stamp that you had to place on your lawnmower. Oddly enough, it was in the shape of a crown, so it's kind of ironic, but you'll see various forms of these things when you travel place to place across the nation. State and local tax revenue as a share of the GDP. Once again, it's what the states bring in to take care of themselves. Relatively flat, somewhere between 8 to 10%. federal deficits and a national debt, annual budget deficit or surplus. And basically, the fiscal year for the country starts October 1 and September 30th. Budget deficit, once again, what was borrowed in one particular year. National debt is the cumulative effect of all the borrowing over the years. Also, if we have a surplus, that takes away from the debt. If we continue to run deficits year after year after year, that contributes to the growth of the national debt. And that's the dollar value of all the outstanding treasury bonds which the federal government owes money. Pattern of federal budgets and deficits and surpluses from 1929 till 2014. And you can see the federal deficit as a percentage. And you can see a real big dip, to negative 30, right around the World War II period. And so basically we've run a deficit probably more times than not. The little spikes you see bouncing above the line are times where we've actually had surpluses, but you can see they're far fewer than the deficits. Federal debt as a percentage of GDP from 1940 to somewhat near present, and you'll see the federal debt as a percentage of GDP has it has varied quite a lot. Here around World War II, it was about 110%. Subsequent years, it kind of leveled off until some kind of a low somewhere in the 1970s, and then came back up for a while during the 1990s, where we experienced a really great economy, and then we had a dip here, and more recently the federal debt as a percentage of GDP, because we've had a stimulus and what they call quantitative easing, which is really the printing of money during the 2008-2009 recession. So that's why it rose real sharply during that period. We have somewhere around 25 trillion out in debt right now, I'm assuming, but there's a debt clock. You can take a look out there on the web and see what that is pretty much at any given point in time. Total government spending and taxes as a share of GDP, tax receipts. You can see the red dotted line. And so this is what we've collected over the various years. This is a slightly shorter time period from around 1990 to 2015 versus total spending. So there were here, like what we saw in the other graph, this is a period where we took in more tax receipts than what we spent. And so the late 90s till about 2002, 2003, we actually had a surplus. And after that, we took a dip where spending went over and above. You'll see this big, spike over here in terms of how much we've paid, spent. Once again, it's the stimulus packages that we put together, the quantitative easing, the printing of money, and the issuance of bonds that created that spike. We're going to probably see another one here presently with the COVID crisis. It'll also be quite large. Fiscal policy to fight recession, unemployment, and inflation. This is something that the government will do in terms of tax policy. This is the Department of Treasury that handles most of this. The Federal Reserve Bank has a lot to do with how this gets implemented. Expansionary fiscal policy increases the aggregate level of demand, either through government spending or cuts of taxes. Contractionary policy is just the opposite. It decreases the level of aggregate demand either through cuts in government spending or increases of taxes. I could say lately the notion of cuts in government spending is more or less a joke. Presently, they have been spending as much, if not more, than they ever have in recent years, regardless of party. Increase in taxes. There's a lot of machinations involved in the tax code and the tax system. A recent change implemented by the current president, basically got rid of things like personal exemptions, and just kind of had a standardized deduction of let's say $24,000 for a married couple, regardless of kids or no kids. And for some people, that was okay. I can honestly say the middle class did not particularly benefit from that on the average. And so, in any tax scheme and any codification of tax law, there are always winners and losers. And whatever the current tax law is today is always subject to change. Healthy, growing economy, and so in a well-functioning economy, each year the aggregate supply and aggregate demand shift to the right, so the equilibrium shifts over to the right and rises up a little bit higher each time. Each year produces at a potential GDP with only a small inflationary increase in price. Previous sessions, I've said that target inflation number is usually around 2%. I'm not sure what's so magical about it, but that's what they say. That's basically stable growth and let's say reasonable inflation. So if you take a look at the rule of 72, the rule of 72 is you take the interest rate and you divide it into 72, and that's the number of years for it takes an investment, or let's say a price on a good, to double. In this case, it would be 36 years, for a price to double. So that's probably why it's something that, is almost to be expected and sustainable. Expansionary fiscal policy illustrated. And so in the output equilibrium 0, it represents during, let's say, a recession. So we're in a recessionary time frame here. We're going to shift the aggregate demand from 80 to the right to 81, and the short run aggregate supply will remain the same, and the long run aggregate supply is this line here, the growth in GDP. We're going to shift this number over to here. We're at equilibrium point, so we're the potential GDP is pretty much on par with the real GDP, whereas before we were well below the potential GDP. Contractionary fiscal policy. This is when the economy is probably deemed to be running a little too hot, meaning that you have high levels of inflation, maybe too much money supply, and so the framework in which everything operates becomes a little bit more unstable, and so the federal bank gets real nervous about runaway inflation, so they sometimes will put on the brakes and bring the GDP level, where if it's running, above the potential, real GDP is hotter than the potential dictated by the long run aggregate supply. They'll go ahead and raise interest rates or do some other fiscal action to curb the growth and cool off the economy a little bit, where once again we go back to the proper equilibrium point where real GDP and potential GDP intersect. Discretionary fiscal policies, when the government passes a new law that will change the tax or spending levels with the intent of influencing overall economic activity. 2009 stimulus package was an example. Right now, there's a 2020 stimulus package aimed at small business and individuals as a result of the COVID crisis. So we'll see what happens with all this when this kind of cools down. Automatic stabilizers, tax and spending rules having an effect of slowing down the rate of decreasing aggregate demand when the economy slows down, restraining aggregate demand when the economy speeds up without any additional change in legislation. Unemployment insurance and food stamps are examples. Standardized employment deficit or surplus. So standardized employment budget is a deficit or surplus in any given year of what it would have been for the economy, producing a potential GDP. So if people who look for work were finding jobs and businesses were making normal profits, eliminates the impact of automatic stabilizers. Comparison of actual budget deficits with standardized employment deficit. And you'll see from about 1970 to 2015, when the economy is in a recession, the standardized employment budget is less than the actual budget deficit because the economy is below potential GDP. And the automatic stabilizers are reducing taxes and increasing government spending. Standard employment deficits. So you have the red line, which is standardized deficit surplus, and then the actual deficit surplus. And you'll see that they meet and cross at various points. They kind of more or less track each other. When the economy's performance, very well, the deficit surplus is actually higher than the actual budget deficit or surplus because the economy is producing about potential GDP, so the automatic stabilizers are increasing taxes or reducing the need for government spending. In this particular case, there are some downsides to discretionary fiscal policy. They are interconnected. Crowding out is when government borrowing and spending in higher interest rate environments will reduce business investment and household consumption. That's the negative. Fiscal policy and interest rates examples. This is something that most people, if they're tracking business news, these are the things that people are most familiar with, and it's government policy with respect to the lending rates inside the United States or any given country. And so, as when a government borrows money in the financial capital market, it causes a shift in demand. So it goes from D0 to D1. And in kind, the equilibrium that you had at 800 billion at a 6% interest rate says that at 900, the new equilibrium will be at a 7%. So it's a way of, that's basically a way of raising the rates to expand fiscal policy. There are long and variable time lags. It could also take time to enact the policy. So recognition lag, meaning that first you have to recognize there's a problem, so there has to be an ongoing track record of fiscal activity that let's say may raise the red flag at the first place. And then the legislative flag is when we decide that we're going to fix something. The government decides to fix something. It'll go through the legislative process to get a bill to address that. And then there's the implementation lag, the time it takes for funds to be dispersed to the appropriate agency. So it could be quite a lengthy process. It depends on really the motivation of all the parties involved. That's the individuals, businesses, and the government, and how they want to tackle a problem. There's a real sense of urgency presently, so they seem to be a little bit more in tune with the idea of getting things done quickly as opposed to what traditionally takes a very long period of time. However, these three things are still present in even the COVID crisis right now. We are trying to get things legislated so that we can get help out to people. It's taking still a little bit longer than people would like. There's no instant fixes. That's basically it. The question of a balanced budget, and it's been something that's come and gone. In many election cycles, it's a very often used election platform for presidential elections. And there's a lot of people that say that if we had a balanced budget, we wouldn't have a problem with national debt. And so there are arguments for it. In the short term, economists would expect budget deficits, surpluses to fluctuate up and down with the economy, and the automatic stabilizers, recessions, larger deficits, or smaller surpluses, and the opposite with economic booms. In the long term, running large budget deficits through long-term investments in human capital and physical infrastructure could build the country's long-term productivity. This could not be done done with a required balanced budget. So, long-term view things would be pretty much stifled uh, by the idea of the use of a balanced budget. This concludes Chapter 17.